Hi, this is Kribakaran Rajendran, founder of algo trading firm squareofbots.com, and we have Vishal Mehta, who's founder of Market Scanner. And we are starting the enhanced session again, where we used to discuss about trading systems and multiple things related to trading system, which could enhance your overall trading performance. So, as a part of this series, in this session, we have Vishal Mehta, who would be presenting the topic related to market structures, market regimes in specific, and how do you create your own edges based out of market structures. So over to you, Vishal.
Thank you, Kiru. I've been missing you, man. How's your health now?
Yeah, I'm good. I'm good. Fine now, man.
No, I think so. I really miss doing this enhanced session. So let me
Definitely.
start my presentation, Kiru, and let me know once you're able to
Sure.
see the presentation. Can you see the presentation?
Yeah, it's clear.
Awesome, awesome. So now let me just talk about. So today I'm going to talk about the big edge. I remember we watching the movie called as The Big Shot, right? So it's I kind of named it as like the big edge. Obviously, we're going to talk about certain indicators and everything. So I'm going to present that. This is my fundamental philosophy, and I've been reading in a lot of books. Okay, and when you read on this book, you really want to validate those statements. So the statement that we keep on hearing, Kiru, is asset classes are trend following in the long term and what mean reverting in the short term.
That's
And
right. That's right.
specifically when it comes to the equity market and commodity market, they are trend following in the long term and mean reverting in the short term. So this is a blanket statement wherever you go. You hear in a book or on a webinar or a seminar or wherever you go, you hear this. So we went out on a mission to figure out like whether does it really make sense of trend following in the long term and mean reverting in the short term. So let's focus on the first statement right now. Trend following in the long term. So before jumping into trend following, Kiru, what we did was we are a data people, right? We want to understand the data. We have to understand how the market regime changes. So I've taken a data from 2011, and when you want to build your systems, you want to make sure that you take your system into two bull regime and a two bear regime. So that's what we were trying to figure out whether if we have a sufficient sample space. And sometimes people say you have to take it from way back in 1992. There are people who have been doing for like Dow Jones from 1900s, but the market structures are evolved. So there has to be a certain data after which you know the market dynamics changed. And that's where you really wanted to keep your data updated. So that's what we did, Kiru, in terms of bringing the market regime. And people do talk about like you have to take as much as data as possible, but you have to understand the market dynamics changed. After a point of time, market goes into a newer structure. Okay, computer comes in. Obviously, I understand the greed and fear does not go away, but the intensity of the greed and fear, because when the machine starts getting involved, may get accentuated. And that's what you have to keep in mind when you're backtesting your data. So that's what we did. We took the data of Bank Nifty from 2011 to 2022. And as we say, that if there is a drop of more than 25% from the peak, then it is considered as a bear market. Obviously, you can always argue that it's not a right definition or it's whatever. But less for our understanding purpose, we want to regime the market into a bull phase and a bear phase. So anything greater than 20-25%, we are going to call them as a bear phase. So from 2011 to 2012, market fell by 5,000 points, which is 41% drop. Then from 2012 to 2015, we had a nice bit of rally of 13,000 points. That's approximately 168 points, 168 percentage. Then from 2015 to 2016, we had a nice drop in a bear phase, which was more than 35%, about 7,433 points. And then from 2016 to 2020, which had the amazing bull run of 19,000 points, around 141% rally. And then we again had a unfortunate corona crash where market dropped by 50%. But then it recovered as swiftly as possible. And again back in 2022 around 25,674 points, about 159 points. Now, if you see this data, Kiru, we have taken this data where we have seen 3 bear phases and 3 bull phases. And if you're going to build a system or trying to find the edge in the market, it really depicts what's the underlying structure of the market. And that's what we are going to try to do, understand what is the behavior of the prices in this market right now. Okay. So what we did was we took the data from 2011 from 3rd of Jan, where the Nifty opened at Bank Nifty opened at 11,920 till we did our analysis, which was 20th of July, which was 37,380 closing basis. Okay. So, Kiru, fire up your calculator. Can you tell me how much points did we travel from 11,920 to 37,381 points? Can you fire up your this thing calculator and tell me?
Is it 26,000 points?
Almost. So you're good at
Okay.
maths, bro. So it's about 25,461 points travel. So remember that 2011 to 2022, we had seen 3 bull phases and 3 bear phases, right? Now we talked about how the market structure is. What do I mean by intraday return? What do I mean by intraday return is basically if assuming, and this is not a strategy by the way, and we have been very clear from the day one when we started announce, we don't want to give a strategy. We want to give you concepts and the edges on which you build your strategies, right? So let's understand this part. Say intraday return. Assuming you get at 11,920, you buy at NT. I know nobody can buy the opening prices, but just to understand the market structure, say you buy at 11,920 and you close at 11,882. Okay, you close at 11,920 and you close at 11,882. That's your minus 38 points of intraday return. I'm not talking about stop losses. I'm just talking about how the market behaves. Clear with me?
Right, right.
Just be with me. I'll keep on checking on that. Okay. So
Yeah, sure.
11,920 to 11,882 Bank Nifty travel minus 38 points. Now, how about overnight return? Overnight return is nothing but you buy at the closing 11,882 and you sell at the next day opening 11,950. That's your overnight return, and we can call it in our daily trading term as BTST. If you had bought at the closing, if you would have sold at the opening, how much profit you would have made. Now I'm going to ask you a very, very tricky question. Out of these 25,461 points that you see, Kiru, how much of has been contributed by the intraday return and how much of it contributed by the overnight return?
Maximum percentage should have been contributed by overnight return than the intraday return. In fact, the intraday return should be negative, I guess.
So this is the problem with you when I'm doing this enhanced session because you know a lot of stuff. See, if a new person would have said, okay, most of the money has been made in intraday and only few on the overnight return, and this is the reality of the life. Out of 28,000 points, okay, 25,000 points, 28,000 points have come in overnight, and as you were rightly mentioned, that intraday return is negative minus 3,000 points. But we as a trader, most of the traders have a long bias. Okay. And we keep on complaining about that we don't make money on intraday. There is some problem because the underlying drift of the market is on the downside and the real money is actually made on the overnight. And that's why BTST kind of scenario works. But hey, this is an underlying edge. But can we build a small system? Obviously, it's not like a full-fledged system, but just to get an understanding of how do I make money in this overnight market as well. And that's where we took one more step and went forward. Okay. So we segregated this into two parts, bull regime and a bear regime. So when I went to this New York Stock Exchange, this is mandatory photo that you have to click, right? So most of the people click a photograph with the bull ahead. But I'm a bear guy as well. So I go behind and grab the balls. So it's a bull regime and a bear regime for us, right? So
Right, right.
what we did was divide this market into overnight market into bull regime and a bear regime. So there are various ways of defining bull regime and a bear regime, but there is a one very famous way of defining the bull regime that I will talk about. So what we did, we took 5 minute chart, okay, which is on an intraday chart. Whenever 14 period RSI goes greater than 60, that's my entry point. What is my exit point? Till it closes below 40. And I think so. There is a very famous trader who propounded this theory. Unfortunately, I forgot the name, but he came out with this range shift concepts of 60 and 40. Most of the time, we talked about market, market between 70s and overbought and 30s and oversold. That's how the founder kind of proposed to it. But he figured it out. Whenever the RSI 14 is greater than 60, the market tends to have a big trend till it closes below 40, and then position, you take it overnight. Now this is how I'm going to look at the chart right now. This is the period on which obviously there were certain periods here also, but I'm just for the easy calculation purpose, we're going to put it whenever the RSI 14 period RSI cross about 60, that's your entry point. About 30,046.445, that was your entry point. During this entire bull period, the market closed here, you took over the overnight position. Market closed here, you took over the entire overnight position. Market would have closed somewhere around here, you took the entire overnight position. You kept on doing it till it crossed below 40. And when it crossed below 40, you exited. That is 34,155.75 points. That's how you have actually benefited in a bull regime, and a profit of 4,109 points, right? So far so clear, Kiru? Like in a
Right.
bull
Yeah.
regime greater than 60, we go entry. Again, I'm repeating, it's not a strategy, it's just to tell you how you find the edge in the market and what kind of a structure can be played along. Okay, till it crosses 60, you are in a bull regime, and if it does not crosses below 40, you continue. Here you may think it is crossed, but we checked our data and it did not. It was like 40 point something, which did not cross below 40. And this is the junction where it crossed below 40. So that was a profitable example. We will not always have profits, right? This is an example of a loss making. Say, assuming just before the closing, RSI crossed above 60, and that was my entry point. But next day, what happened? It was a bull regime, so I would have taken position at home, thinking thinking that market will go up. But what happened to the prices next day? Some adverse news would have come, and it crossed below 40. That means it was my indication to get out of the market, and I would have closed at 33,566 points. That's a big loss of 1,023 points. So we have seen a profit of 4,000 points also, and we have seen a loss of minus 1,000 point also. Now let's talk about the bear regime. Similar concept, Kiru. It's a time frame 5 minute chart, but here the rules of the bear regime changes from a bull regime. That whenever 14 period RSI is less than 40, you enter into a short position or market is into a bear regime till it closes above 60. The minute it crosses above 60, it's your stop and reverse, and it becomes a bull regime for you. And then simply you take your positions overnight. Now, if you look at this, Kiru, let's take an example here. The RSI closed below 40. So that was your sign for going short on the market in a bear regime. You can see 36,946 was our reference level for Bank Nifty. But during its entire bear phase or a bear regime, the market was not able to go above 60 till this point of time. And it crossed above 60 at this juncture at 34,454. Now that was a big bear market for us. And we did about 2,400 or 2,500 odd levels on the Bank Nifty points. An entire journey, we took our positions overnight. So if you see over here, the market closed here, we remained short. Entire day the market went down, we were happy. At this juncture also we remained shorted. Market gap down, and we kept on doing this till this point of time where the market changed its regime from a bear regime to a bull regime. But we exited our short position here. Let's take another example of a loss making trade, right? Here you can see that RSI went below 40. So you would have gone short at 34,342, but the market recovered back subsequently and making a new high. So it was somewhere around 34,922 where we exited our position and we had a loss of minus 580 points. So we have
Right.
seen
So
bull regime, bear regime, profitable trade, loss making trade. Yes, Kiru, you had a question. Yeah.
So what I was saying is, so as long as the market is trending, you would know this RSI trades would be in profit. But the only issue is whenever there is a gap ups or gap downs immediately after your position, that is where no it is ending up in loss. So addition to this RSI, if you could add a gap filter condition, say suppose your RSI is giving you a short signal here in this example. So add one more gap filter condition where you monitor the initial 15 minutes and see if the 15 minutes range is breaking out. If
Wow.
it is not breaking out, then don't take a trade. If it is breaking out in your direction, then take a trade. So as per RSI, if it shows short, and
Mhm.
if the 15 minutes range is breaking down and it is also going down, then you initiate a short.
Wow.
Otherwise, you waiting for 15 minutes and then see if it is moving up, then don't take a short. So
Yeah.
likewise, if you just because only enemy in this example that so far I have found it is gaps. So if you could add this gap condition, probably it could enhance the performance.
No, I
That
think
is
so
my idea.
that's the idea of enhance, right? We are constantly looking to share our thoughts, and I encourage our audience as well upon talking about how what your thought process, my thought process, and we encourage our viewers also to put their thought also in the comment section. That will help us to kind of think more, because that's right now two minds are thinking, but when there are thousands and thousand people are watching this, there are thousand new ideas that is coming in, and that's how we share
Definitely.
and we grow together. But you are
Definitely. So
right,
this
and
is
I'm
just
going
a
to put out that thing on the
yeah,
website.
so it's kind of a starting point. Like, okay, this is how you could get started with building a system. So it is not a plain vanilla system where you can tomorrow directly start reading this, whatever we are discussing here. Because the idea when we started this NN session is not to share you or spoon feed you with any specific trading strategy. We'll just discuss about how to get started with trading strategy. From there, we can build it on. So just like how we suggested a gap condition to this, you can also change it. Like for an example, instead of 5 minutes time frame, we can move to a 30 minutes time frame or higher time frame, so that the gaps doesn't affect much. So likewise, you can add filters and then enhance the overall systems from there.
Awesome, awesome, Kiru. So let's do this quickly, Kiru.
Yeah.
Okay. So what really changed was for me. So we put it out our equity curve. What do I mean by bull regime and a bear regime? Is basically bull regime is whenever RSI is greater than 60 and I go long till it crosses below 40. It's a bull regime. Okay. And what is a bear regime? Bear regime is very clear that market goes below 40 till it remains below 40 and it does not crosses above 60. It is into a bear regime. What surprised us was the number of points that we were gaining when we were in a bull regime and what number of points that we gained in a bear regime. So in a bull regime, we made 44,314 points, whereas in a bear regime, we made 15,251 points. So let's park this concept for a while over here. Okay. What it does tells you in the bull regime that we made 44,000 points. In a bear regime, we only made 15,000 points. Now we're going to
Right.
take another leap step. So we made total of 59,000 points, but obviously we see the diversification. We talked about another interesting concepts. Assets are trend following in the long term, but what was the missing part? Hero, mean reverting in the short term. So now let's understand the structure of the market in the mean reversion and in the short term. So what is the mean reverting in the short term? Let's focus on that part first. So what is mean reverting? Very simple. We have a legendary cricketer Virat Kohli. Okay, and I love him. There is a famous saying: you can love him, you can hate him, but you cannot ignore him. He's that kind of a character. So I like
Right.
Virat Kohli, the way he goes about his aggression and get things done. But as we know that everybody goes through a tough phase, and he did went through a tough phase. People were telling him that he may not be the one that we were thinking about, and he was going through a very lull period where he did not score a century as well for the longest period. But then he's Virat Kohli is a class apart. He comes back, and that in Asia Cup in the last match against Afghanistan, he scored a good knock. So that's nothing but a mean diversion. And we have in our enhanced session talked about a lot about what is mean diversion. And mean diversion is something what I also personally like a lot to trade on. So that means there is a trend and you are trying to buy in that trend. So mean diversion, why it is very interesting, because it lasts for few hours to few days. That is very comfortable for traders like us. You buy low and sell high, or sell high and buy low. You get a very better entry, better risk to reward ratio. Then you have high win to loss ratio. A lot of people, when they come to trading, obviously we can debate and talk about it. Like in trend following, it is the other way around. But a lot of traders like this part, high win to loss ratio, because they want to consistently make some money. And there is a lot of psychological angle involved into it. I like why I do mean reversion, because it smoothens my equity curve to a different level. Because when I'm doing my trend following strategies, the equity curve always goes up, but there are big drawdowns. And mean reversion trading strategies actually helps me in those difficult period of trend following. So my overall equity curve becomes quite smoother. It has a low drawdown. So I'm going to talk about one indicator which is one of my favorite, which is best when it comes to mean reversion. So this is indicator which we can define it whenever it goes below 20, you buy, or it is an overbought market, and whenever it is above 80, you oversold. So the trend was up, so I'm looking to buy on the dip. And as you can see, whenever this indicator went below 20, we will be near the bottom. I'm not telling it we will be exactly at the bottom. We will be near the bottom. There was
What is the
one
name
which
of the
missed.
indicator, Vishal?
I'll come to that. I'm going to ask you. But can you see the almost accuracy of this indicator?
Right,
Whenever the
right.
market is going below 20, there is a tendency of the market to make a bottom in 2 or 3 bar next to each other. I'm not saying it is 100%, but we have seen this. It is at 70% accuracy. Now, a question always comes, Kiru, in your mind and even in my mind and everybody's mind. Which is this holy grail indicator? There is no holy
Is it
grail.
RSI again?
Yes, but the periodicity,
Changes. Okay.
the periodicity is only 2 period RSI. You will not see it, but it's a 2 period
Right.
RSI, and it is propounded by Larry Connors, and I'm a big fan of Larry Connors. Unfortunately, I never got a time to meet him when I was in New York. He was supposed to meet me, but we could not. But I really loved the way he came about developing this indicator called as 2 period RSI, and it works like a charm. Okay, and it is best when it comes to the mean reversion trading strategy. My journey as a systematic trading started because of Larry Connors, because I kept on reading a lot of Larry Connors book, and he talked about edges back and again and again and again and again. So I highly encourage to all the viewers that if they are interested in building some mean reversion trading strategy, do follow Larry Connors. Now this is a classical bear market, and we mentioned that whenever it goes above 80, market tends to make a top. Now you can see over whenever it goes above 80, obviously here you can see it took about 1, 2, 3, 4 bars, and then finally the top was made. But what I'm trying to say is it's not 100% indicator, but you can see almost with 70% accuracy, it will help you to catch a top or a bottom. And the beauty about this is basically, you are finding near the top, near the bottom. So your risk to reward ratios are very much in your favor. So now what we did was, you really wanted to buy in a bull regime. Okay, you want to do a mean reversion buy strategy in a bull regime. What do I mean by that? Assuming, Kiru, you want to go this side, right? You want to go on the right hand side of yours, and the water flow is also from the right hand side. So what you have to do is just go a little backward, and the
Right.
force will come and it will push you ahead, right?
Right.
Yes, and that's what I'm trying to do over here. I'm not going against the trend. But if you go back to the previous diagram that I showed here, so the trend was up. What I'm trying to do is the risk and reward ratios will be in my favor. When the market trend is up, I'm going to buy around this dip and play this rally. When it comes down, I'm not going to short this because the overall trend is up, and that's what we say, trend is your friend. Yeah, there is another part of it until it bends, but as of now I have evidence that the trend was still up. So what will I do?
Right.
I will buy this over here, and then the market will go up. So this is what I try to do on this strategy. Now, so like we said, this indicator for a mean reversion, whenever it goes above 80, it gives you a probable top. As I told you, it's not going to be 100%, but it's what I call it as a near holy grail to find the tops and the bottoms for a short term mean reversion trade. So what we did was we created a small system, okay, just to test the underlying principle. So we took again the 5 minute time frame. What we did was the market has to be in bull regime. So Kiru, what if we would have said bull regime? Where do you think the bull regime would have started from? If you can just recollect, how do I define the bull regime?
So whenever the market goes above RSI 60,
Mm-hmm.
and also when it falls below 40, we have to close it with an overnight position of time
Yes.
5
So
minutes time
basically,
frame.
whenever it goes above 60, we entered into a bull regime till it closes below 40. That is RSI 40.
Right. Right.
But what we are going to do is to play in the mean reversion market. We will have a bull regime whenever it crossed above 60. That means the market would have been already be up. So we don't buy
Right.
on the bull regime. We wait for the first pullback. Okay.
Okay, basically we are entering into a pullback on an uptrend.
Yes, that's what we want to achieve with the mean reversion in the bull market. Okay. So 2 period RSI less than 20, we enter. Now, this is a very interesting concept that has been propounded by Larry Connors itself. And what was very clear is this 2 period RSI works like a charm. But the only problem with that indicator is you have to buy when the market is actually falling. And that's what Warren Buffett says, right? Buy when there is blood on the market, or buy when everybody's selling, and sell when everybody's buying. So if you really wanted to play a mean reversion game really well, what you can do is you cannot, just go in with just one mean reversion trade. You have to break down your trades into at least 2 or 3 or 4 parts. So never go all in. Assuming you have 100 shares, what you do is you buy 25, 25, 25, 25, because you never know where the market is going to make a bottom. It's like catching a falling knife, but that's where the edge is. And I bet you and I guarantee you, 95% of the people that I've met, retail side, what they do is they buy when there is a green candle on the breakout, and they complain, say, whenever we buy, market goes down, and whenever we sell on a red candle, the market tends to go up. And that's exactly what mean reversion players actually benefits from, because mean reversion players like us, we buy when the candle is red. So whenever market is selling, we are buying, although there is a risk. We are talking about catching a falling knife, but with proper risk management. There are people who are against martingale strategy. That means every time you make a loss, you double up your position. I'm here not talking about doubling up the position with the risk defined parameters. So there is always a better chance for you to be successful in this strategy. So what I do, if it is remain below 20, I'm going to buy my first lot. On the next day, if it closes below my entry price, I will now ignore the 20 period. I'm going to keep on looking at the my entry price. If it closes below my entry price, I'm going to buy the second lot. If it closes below my entry price, I'm going to buy the third lot. And if it closes below my entry price, I'm going to buy the fourth lot. And after that, I'm not going to buy anything more. So what is my exit criteria? My exit criteria is whenever 2 period RSI is greater than 80, or 0.4% or 0.5%. This is also a very interesting way we figured out to figure out what is the general tendency of the market. Okay, and it can be a topic of itself, and maybe I'm going to do a session on that only, how to decide the stop losses. So this stop loss for the timing I'm going to talk about came from an MAE, maximum adverse excursion of the profitable trades. Be with me right now. We are going to talk in detail in one of the new analysis sessions where we talk about what is MAE, MFE, and how do you use them to decide the stop losses and underlying behavior of the market. So these are the two conditions that we kept it, and we do this position only intraday. Okay, we do this position only intraday. Now look at this. This is RSI 14. This is 2-period RSI. So whenever it cross 60, that means we are into a bull regime. So from this period, we are looking to only buy in the market, buy dip in the market. So the market went up. In our trend following model, we would have gone long here. But as we say, we are planning to do a mean reverting in the bull regime. Bull regime started. I'm waiting for the market to come back. And as you can see, 1, 2, 3, 4, after fourth bar on a red candle or a black candle, depending on your software that you're using, it went below 20. So you actually buy when the market is actually falling, and that's what real mean reversion is all about. You buy when everybody's selling. Most of the traders will be getting out, and that's why it is a red candle. But you have to take your neck out somewhere and buy it. So you buy here. And what did I say? Whenever 2-period RSI goes above 80, you exit your position. That's pretty much about it, right? Now, remember this. Again, you're still in the bull regime because it has not crossed below 40. You're still in the bull regime. Now you had a 1 candle, 2 candle, which was above. The 2-period RSI was not closing below 20. But on this black candle, the third black candle, the market closed. Remember, I told you that nobody can predict the market. Nobody can figure out when the bottom will be. And especially when you are doing a mean reversion. So you don't buy at one go. You actually bifurcate your trades into 4 parts. So I buy my first part over here. Next time the market closes even lower than my initial entry price, as the candle was green or red or black, I'm going to buy the second. But you can see these two were actually above my buying price. So I'm going to ignore them. But this one was below my second purchase price. So that's my third point. After 3 bars, the closing was not below my purchase price. After 1, 2, 3, 4, what did happen to the RSI? 2-period RSI was greater than 80. So I was 1, 2, 3. I have 3 positions. Got out at 80. Now this is what we are going to do on the mean reversion side on the bull regime. Now let's talk about in mean reversion on the bear regime. 5-minute chart. Kiru, help me. What is a bear regime?
So when it drops below 60,
I caught you. Wrong answer.
no, sorry, below 40, man.
Yes. So
14
whenever
RSI below 40.
14-period RSI below 40 till it remains below 60. If it crosses,
Right.
then we turn into a bull regime. So it's kind of a stop and reverse, right?
Right,
But it
right,
is in a
right.
bear regime, and we are looking to sell the first pullback on the upside or short covering rally. We want to short that out. And then, as we talked about, that we are going to scale in because we don't know when the market is going to make a top. And where will I exit? 2-period RSI less than 20 or the 0.4% stop loss. And I'm going to keep my position intraday. Now let's take with an example. What happened to the prices? The regime, it was trading about 60, 60, 60, 60. Here, it crossed below 40. That means I have moved from a bull regime, from a trend uptrend to a downtrend. Now my job as a trader is to look out for the first pullback or second pullback or third pullback till it goes above 60. Okay. Now what happened was, this is a very good example that we did. Now when it was in a bear regime, we waited for the RSI to go above 80. And this was the period that I went in. Ideally, there was another little closing, so I would have scaled in the second part as well, which I missed out on. So this was the second entry. And then what happened to the prices? 1, 2, and 3. 2-period RSI below 20. That means I entered here. my short position and covered my position over here. This is another example. Now, this is a very important consideration. Okay, why I put out this example is, again, I'm still in the bear regime. 2 period RSI was greater than 80, so I would have entered the short. So that was my first enter. After that, I forget bull regime, bear regime till I get my exit prices somewhere around here, I think so. Okay. So I continue to create my short position till I get my position, and then for me, then bull regime have started. So I will try to buy the pullbacks. So this was my first entry. This was my second entry. This was my third entry, my fourth entry. I will be very honest, my stop loss was triggered here somewhere around on third. So point 0.4 from your initial entry. So this point 0.4 from here, point 0.4
Right.
from second entry. So every entry has a 0.4% stop loss on the upside. So maybe one or two would have got triggered, but third and fourth were remaining because market did not go up. What did happen to the RSI? RSI went below 20, and that is where we exited our position. Now,
So
if
if we
we,
have four positions open, the average price we shouldn't consider that and then use a stop loss. Instead, we should use the individual level stop loss of 0.4%.
that is correct from your entry price.
Right.
Okay. So this is just an understanding how these structures behaves in the market. And what was very interesting when we ran this strategy is, if I'm trading that strategy intraday, mean reversion, okay, on the long side, it gave me out of 66,000 points. On the long side, 18,641 points came from the long side. But on the short side, the return that we got generated was 48,180. Okay. Now it may not, it's just too much of information, but let me just compress that information, and which will completely change the way we think about the market structures. So first we started with intraday return and overnight return, where we said, okay, we made about 30,000, 25,000 points. In intraday, if we were going long, remember we were going long on the open and we were closing our position at the closing. That was intraday return, Kiru. Yes.
Yes, yes.
It gave us a negative 3,000 points. But on the overnight, it gave me 28,000 points. So what it was showing you, the edge is on the short side. Okay. And for me to go long, edge is on the long side. So far clear?
Right.
In a bull regime, what we studied is, whenever we are in bull regime and we are taking our position overnight, we are making 44,000 points. In a bear regime, we are making only 15,000 points. So what it tells you, there is a higher edge on the long side when you are carrying over your position. But there is a minor edge when you are carrying the short position overnight.
This is with respect to trend following.
Trend following. And then there was a mean reversion, where on an intraday basis, in the mean reversion, there is a small edge in going long, but there is a big edge in going on the short side. Now, if I'm going to combine all of them together in a picture, the story becomes very clear for me. What it shows, that if I wanted to be long overnight returns, if you can see, the general tendency of the market is to go up on the BTST, or we remember we said, okay, you buy at the closing and you sell at the next day open, BTST, right? There is a positive 28,000 points return that is generating. That also get confirmed by the overnight trend following strategy when we are in a bull regime by 44,000 points. That means whenever there is a bias positive signal, whenever there is a positive signal, you take over your position home. There is a very high probability that you will get a good gap up in your favor. Most of the people are afraid to take their position overnight because they will think the market is going to crash big time in the next day. But remember, we took this data from 2011 to 2022, 11 years, where we had 3 bear phases more than 25 points. We had a corona crash in between. We have 2016, 18, 19 fall. We had a 2011 to 12 fall. We had seen 3 bear phases more than 45% also. But what the data shows us, there is a very good tendency of the market to become bull and take overnight position when the market is bullish. Very clear? And the story also unfolds very clearly for us. We said whenever we go long on intraday, we actually have a negative return. And that gets confirmed with our intraday mean reversion trading strategy. So intraday mean reversion strategy, if you see, we are making 48,000 points, but we are hardly making any points on the long side on intraday mean reversion. So this also coincide with our major study that in intraday, market tends to go down and it can accentuate your profit if you are doing a mean reversion on intraday. So to summarize the story, if you really wanted to make money in the market, you can have a BTST and overnight position on the long side, and you create a position on the short side on the intraday market. And when you combine these two together, there is a very high probability that you will get a very smooth equity curve. And that's what I really wanted to emphasize with this. And with this, we highly encourage you to subscribe to our YouTube channel and Square of YouTube channel, because we are putting lot of effort to come out this strategies or this concepts can be taught in webinars for costing thousands and thousands of rupees. But we are just putting out, so we are putting so much of an effort. So we at least expect you to like it if you really like it, and subscribe to our channel.
Thank you so much, Vishal. And whatever things that you have shared is the core concept, as you said. It is built completely based on core concept of market structures. So specifically, as you said, when you are going long on overnight positions, most people are afraid of holding it because of the gap downs, or because of the gaps that could work against them. But historically, what I have studied is, if you're a trend follower, and that too if you're a positional trader who's a trend follower holding overnight positions, most of the time the gaps is going to be your friend. It is not going to be your enemy. Once you capture the trend, it eventually goes in your direction. The gaps doesn't go against your direction most of the time as a trend following. So that is what I have observed, and that is what your data has also suggested. So it is a good exercise to get started with this weekend. People can add more inputs or more filters towards it and make it more robust.
Sure.
Thanks, man. Thank you so much for
Thank
sharing
you,
it.
Kiru. Thank you, everyone, for listening in.
Sure. Thank you, guys. So we'll come up with some other topic next week, and we'll make it more interesting again. Next week. Thank you, guys.
Thank you. Bye bye.